I'm Stephanie Ricca with CoStar News, here with Kevin Davis, America's CEO of JLL Hotels and Hospitality. Kevin, thanks for joining us.
Absolutely, my pleasure.
First question, this is the critical one. I want to know when you are in a place like this, the NYU IHIF show, teeming with industry buyers and sellers, what do people ask you when you see them in the elevator, in the lobby, in the bar? What's the first question they're asking you?
I think the first question is usually, what do you have interesting that's coming to market, and or what markets do you really like or dislike? So look, this conference is about deals,
Yes.
for many of us, and so the folks that we interact with the most are investors,
Okay.
and they're focused on deals. So we find that most of our conversations are around deals. Of course, we catch up about family and industry, other industry stuff, but at the end of the day, the talk is about deals.
It's always going to be about deals.
It's all about the deals.
I am going to circle back to that in a second and ask you the same question. But first, I want to take a look at bigger picture. You know, when I look at JLL's latest U.S. hotel capital markets update, it's pretty rosy, right? For the first quarter, number of hotel transactions in the U.S. was up.
Yes.
Over Q1 25, transaction volume up. They're big trades, right? Big price tags.
Right.
Does this mean the bid-ask gap is over and we're ready to go?
Yeah, look, I think things are definitely moving in a positive direction. I think a lot of it is tied to the fact that, notwithstanding the fact you've seen Treasury rates increase over the past couple of months with the Iran situation and oil prices and concerns about inflation, but a lot of the investors in our sector tend to borrow against floating rate, which is tied to the Fed funds rate, the SOFR index. And that continues to be relatively low. That index is in about 175 basis points over the past 18 months. So, and also credit spreads have come in.
Yes.
So the cost of debt is down plus or minus 300 basis points compared to 18 months ago. So the lower cost of debt, the ready availability of debt, has contributed to an increase in transaction volume. It's also enabled investors to be able to pay more because the cost of debt is down. And then also, I would argue anecdotally, over the past 18 months or so, we've seen cap rates expand.
Yes.
So you have a lower cost of debt, you have higher cap rates, which has facilitated a bridging of the bid-ask. And that's why I think you've seen more transactions take place. The other thing, I mean, we are also seeing stronger than expected RevPAR growth. So I think that's pulling people into the industry and focusing on the sector, and we're seeing a continuation of the bifurcation of luxury and everything else. So there's a really strong bid with luxury outperforming. So there's a really strong bid for luxury assets, for resort assets, and I think that's also contributing to transaction volume as well.
Well, that's been the case. And when you look at the hotel trades in the first quarter, even in the last 12 months, that's been the case, that bifurcation, luxury and resort. And I'm going to ask you about the Diplomat, but is that, I don't want to be a pessimist and say, where's the end of that? But that luxury asset is so strong.
Well, I think I don't know that you can predict the end. If you look at what's happened, I mean, it's a symptom of the K-shaped economy. And as a general matter, wealthier families, individuals, their stock portfolios are up, and they continue to do well economically, and they've got more buying power. And in many cases, they're price inelastic in terms of their willingness to pay. Because they have the resources to do so. And so that's why you're seeing investors focus on the luxury sector, because they feel like they have an ability to push rate, which will ultimately drive returns. The other thing, and this is important, it's incredibly expensive to build a new luxury hotel. And as a result, there are not many of them being built.
Right.
So there's a limit on new supply, coupled with the fact that you have a price inelastic traveler who is willing to pay more, and so I think that's what's driving interest in the sector.
Right. So you've mentioned RevPAR strong, that luxury consumer or guest willing to pay more. Let's talk a little bit about hotel performance metrics. We've seen them, very strong in the first quarter.
Right.
From your perspective at JLL, what are the metrics that, you talked about rate, you talked about RevPAR. Are there other metrics that you worry about or think about, like profitability related, or does
Yeah, well,
everything seem
I think,
okay?
well, it's interesting because we make the mistake frequently speaking about the revenue side of the
Mm-hmm.
equation and less about the expenses. There's absolutely been growth in expenses. I mean, you look at New York City, for example,
Right.
the new union contract,
Mm-hmm.
which was just passed with a 5.5% CAGR on wages over 8 years. Housekeepers over that period, housekeepers' pay will go up about 50%. In 2033,
Mm-hmm.
housekeepers will be making north of $100,000 in New York City. That has, and then you add to that the benefits, growth in the cost of benefits. So that has a real impact. Then you
Mm-hmm.
layer in taxes, you layer in insurance. So those are certainly things that owners concern themselves with, and that is why I think in some of the, if you go down, particularly economy, you've seen negative RevPAR growth.
Right.
Mid-scale, it has turned positive, but mid-scale
That took a long
economy, it's taken a long time,
time.
right? So in the chain scales that cater to the less economically benefited traveler, it's been really challenging. So if you can't push rate and your occupancy is flat or going down, but your expenses are going up, that's a tough conversation as an investor.
Yeah.
And so I think that those have been some of the headwinds that we've faced in the industry. It's great that top line, particularly on the luxury side and upper upscale, has continued to grow, but concerns about expenses are a real thing.
Mm-hmm. And I mentioned I wanted to circle back and talk about the Diplomat Beach Resort in
Hmm.
Florida. So JLL just refinanced it,
Right.
right? $600 million CMBS loan. You also in recent years worked on the sale of it to Trinity Investments, previous refi. All of this happening in generally a somewhat less active or transitionary period of hotel transactions. Tell me about putting the pieces together over the years at this hotel, because it does fit that bill of resort, very nice location. It's got a good brand on it.
Yeah, I think, I mean, yes, it's interesting in that I think it illustrates the power of the Sun Belt and Florida and resort markets in particular. But what you have at the Diplomat, it's a strong group hotel, but you have the ability to flex into leisure.
Mm-hmm.
So you can sort of counterbalance. If group is off, you can flex into leisure. If leisure's off, you can try to flex into group. Really similar dynamic with the JW Marriott Marco Island, which we
Sure.
recently sold and
Yes.
financed. Again, on the beach, big group box, which has significant component of group, significant component of leisure. And what I say was interesting about both those processes. The sales happened at very different times. I mean, the Diplomat sale happened a couple years ago, but the bottom line is incredibly strong investor interest for that profile of asset several years ago. I would argue even stronger interest in that profile of asset today,
Mm-hmm.
as we had a deep bidder pool. You saw it reflected in the sale, but also in the financing,
Mm-hmm.
where lenders really leaned in because of the quality of the asset, the quality of the sponsorship, et cetera. But the reality is, it is virtually impossible, one, to acquire the real estate,
Mm-hmm.
to build those assets, and then two, even if you have the real estate, the cost of construction is astronomically high.
Right.
And so that's why investors place a premium on assets like this, because,
Mm-hmm.
I mean, they are the definition of irreplaceable.
Right. They're those diamonds that are tough to find. So let's close by circling back to that first question I asked you. What do people ask you when you're in the hallways at a conference like this? And you said they want to know where to invest. Talked a little bit about the Sun Belt just now. What do you tell them?
Yeah, look, Florida continues to outperform. I mean, you look at the markets there. Tampa, Miami. I mean, much of South Florida, going further north, Fort Lauderdale. It's been just really strong operating performance. And again, I think a lot of that's tied to the demographic shifts that we've seen. Obviously, Florida's a no state income tax state.
Sure.
You've seen a lot of New Yorkers, Californians move to Florida, a lot of wealth migrating to South Florida. They're bringing business. And I think that's translating into opportunities down there from a hotel perspective. So those are markets that I think will continue to be positive and really reflective of the future. And then you look at a market like New York City. We talked about the wage situation, which is certainly a challenge, but I think most owners were underwriting pretty sizable increases. Now that that's in the rearview mirror, people know how to underwrite wage increases. But if you look at the supply perspective, there's just not a lot of new hotels that'll be built in New York. Most of that is regulatory. It's very difficult to get the approvals to build. And so the supply pipeline in New York City is de minimis. Meanwhile, demand will continue to be very strong. So notwithstanding wage increases, we think you'll see significant increases on the top line to counterbalance, and think New York's a great place to invest long term.
And imagine when the pent-up international inbound
and
finally
when the international
comes.
and particularly the Canadians and the British, who are really the two largest cohorts of global visitors. So we feel bullish about New York City as well.
That's a great note to end on. Thanks for joining us,
Absolutely.
Kevin.
I appreciate it. Thank you.
Thanks.
Take care.
The marquee gathering of the industry's data community is almost here. Join us August 5th through 7th in Nashville for the 18th annual Hotel Data Conference. With a unique mix of attendees, impactful networking, and practical best practices you can put to work immediately, HDC is where data turns into decisions. Visit hoteldataconference.com to view the 2026 lineup and secure your spot today.
This episode of the CoStar News Hotels podcast was recorded on June 1st, 2026, and edited by me, Stephanie Ricca. Find all hotel industry news at costar.com/hotel news. Thanks for listening.